Wow, wow, wow. Really, all I can say is wow, ladies and gents. The feedback that y'all have given me from day one is unmatched. Like all of the comments, all of the feedback, like I said, it was amazing. So, welcome to day 2 of trading camp. Like I said, the first day was amazing, right? So, we spoke about psychology yesterday, right? And then today, we're going to be diving into the 3 phases of the market. Now, of course, we're definitely going to be jumping on the charts because yesterday was psychology based, and that is the most important thing going into trading. But today, we're gonna dive into the nitty gritty, and I want you guys to really take your time with this video and really understand and take notes because I'm giving it to y'all, like I told y'all yesterday, raw, authentic, like everything that y'all gonna need. And it's like you might have to pause the video, you might have to slow it down, you might have to rewind some concepts that I say. But overall, make sure that you understand in totality exactly what it is that I'm going over in this video, right? So let's move my face out the way and let's go ahead and get started and dive right into this, right? So currently I have gold pulled up. Y'all know I love me some gold. Now, when we talk about the 3 phases of the market, we go as such. So 3 phases of the market. This, like I said, this concept is super, super important. It's the foundation of my whole style of trading. Of course, like you can name these things, a few other different things, but this is pretty much how I like to name it. And this is how pretty much I even teach it to my students, right? So the very first phase inside of the market goes as such. It is a impulse, right? So what an impulse is an aggressive push inside of the market, right? So when the market gives you an aggressive push, that's the market telling you, hey, there are more buyers inside of the market or there are more sellers inside of the market. So we can see here, even on gold just hit a new all-time high, just smacked 3,000 a day. Anytime gold wanted to go up, the very first thing that it did was it had an impulse push up. So this is an impulse push up. It is an aggressive push. So anytime you think about an impulse, I want y'all to think about an aggressive push. So very fast, very volatile, all of those things, right? That is when the market is impulsing. But of course, when the market is impulsing, you never just want to be one of those traders that's just jump in for no reason because you can ultimately get faked out without having proper confirmations that come after the impulse. So that's why I say it's 3 phases of the market. You will never just jump in on the impulse because something like this can happen, right? So you can see here, price impulsed up with this huge wick, and then what did it do? It shot all the way back down. So this is gold. This little push right here is at least a solid few hundred pips, right? So 1,600 pips. So if you just one of those people that's like, oh, well, I'm gonna just enter because I see the market going up, then ultimately you are about to get smacked and you are about to lose your money. And it's like you just entering off of literally impulse. Like if you have that fear or you have that like fear of missing out, or you just see the candles and then you just react to it, that is what's gonna cause you to lose your money inside of the market. So it's very, very important that when you think about an impulse, it's like, all right, the market is telling me the direction it wants to go, but that doesn't mean that I just react off of that right then and there. I still have to wait on a few things to occur before I overall just jump inside of the market, right? So let me go ahead and write that definition out for you guys. So impulse is telling us the overall direction the market wants to go. Therefore, if I impulse up, more than likely, more than likely, the market wants to go bullish. But like I mentioned, of course, we don't just enter off of impulses, right? So that leads me to my next phase. So anytime you get an impulse, that's like you breaking a level of resistance, breaking a level of support, got a huge aggressive, sharp move inside of the market, right? So from there, the market then has another phase where after, just think about it. If you run track, right? If you run track and you sprint, if you sprint full speed, you think you're going to be able to maintain that full speed going around the whole track? It's like more than likely you're going to get tired at some point. So what do you have to do? You have to slow down. You have to take a breather. You have to rest. So the market has to do the same thing, because the market never just goes directly straight up. It never goes directly straight down. Like anytime the market is going in a trend, it is going up and it's pulling back. It's going up, it's pulling back, it's going up, it's pulling back, it's going up, pulling back, so forth and so on. So these are the three phases that the market moves. So we never just have a straight push up in one direction without having a pullback. Otherwise, trading would just be vertical lines, like literally up and down movement. Like it wouldn't make sense, right? So we have to give the market time to breathe. So when we have that time to breathe, this is called our correction phase. So our correction is pretty much giving us the indication like, okay, the market is doing what I thought it was doing when it impulsed in that direction. Because typically, if you get an impulse up and then you get an impulse right back down, more than likely that first impulse was like a fake out. So you got to be mindful to say like, okay, I have identified the very first impulse. Now I'm gonna wait on a pullback to occur before I look to take any my positions. But that correction is just its resting period. You as a trader, you want to take advantage of that resting period. That's where you looking to take your overall entries, because you know, like, okay, the market is confirming that overall move, right? So we can say here, confirming the overall direction of the impulse. So once we get that correction, that lets us know, hey, we good to go in that direction. Now we just kind of got to wait on our entry signals. And we're going to talk about that later on in the trading camp, of course. But this is, like I said, the main foundation of my style of trading, right? So when I'm looking for any entry, any type of trade, I'm looking for a brand new impulse. I'm looking for a correction. And then that will lead me to the next phase that we're going to talk about in the last part of this video, right? So when we're looking at our correction, the market has many different types of corrections. And we're going to kind of talk about this later as well when we get into Fibonacci's. But we can have multiple styles of correction. So this correction right here is kind of like a flag pattern here. So we have an impulse, we have a flag, and then we'll go to our next phase. But here we have an impulse, and then we have a correction that just goes sideways. This is more so just like a form of consolidation. This is not like this isn't like a deep pullback. This isn't like a counter trend where it's going the opposite way for a short period of time. It's simply just going sideways and literally consolidating, right? And then you can have those type of corrections where they look like this, where you have an impulse and then you just have like a sharp pullback like this, so forth and so on. And these are the more aggressive pullbacks, but those happen with like the more volatile pairs. Sometimes news affects these type of pullbacks, so forth and so on. But you just being able to understand and identify like, okay, I'm in my correction phase. As long as I'm not breaking, you know, my high points or my low points within my structure, I'm still in this correction phase until this low point here gets invalidated. So if this pulls back deeper, then this impulse was invalid because structure got broken, right? And we're going to talk about structure too. So up until the point where we in this correction phase and if we break this, then we are still looking for our third phase inside of the market to appear. But like I said, this correction phase is confirming the overall direction of the impulse. So once you get that correction, it's like, all right, we could potentially look for a setup to continue to go into the next phase, which is, let's talk about that. Our third phase is our continuation. And our continuation is where we make our moolah, our money. This is where we make our money, ladies and gents. So we do not look to make money on the impulse. We do not look to make money on the correction. We simply look to make money on the continuation. on the continuation. On the continuation, folks. Please do not let this go over your head. And like I said, make sure that y'all taking notes, simply because you don't want to be one of those people that jump in. Like, I'm gonna literally give y'all an example real quick. Like, if you're one of those people, like how I was just mentioning, especially when you don't identify structure, if you just one of those people like, oh my God, gold is freaking melting, we're about to sell it to hell. And it's like, you jumped in right here at this sell. Guess what just happened? Whop, stop loss hit. Market went in the other direction. Why? Because you were so thirsty to jump inside the market and take advantage of the impulse that you got clapped. And that's really what it boils down to. It's like you got clapped simply because you did not wait on the second and the third phase to occur. Now, if you can be patient and you can wait on those confirmations, waiting on that impulse, waiting on that correction, and then look to catch that continuation, that's where you can make consistent money. But until then, it's like, nah, bro. Like, you not gonna just be sufficient just trading like impulse breaks out when you don't even know where the full market is going, right? So to piggyback on this, in this case, this was the initial impulse. And remember, like the example that I gave y'all right here with this steep pullback, that's all that was. But if you don't know structure, and like I said, we're going to talk about structure tomorrow probably, right? This, we had a low, well, we had a higher low, we had a higher high, price pulled back aggressively, but guess what? It never broke the structure. And then we got this overall continuation phase from this overall push. So this is why it's important to understand structure as well. But of course, this main lesson right here is just to understand the three phases, right? So you can call it whatever you want to call it. Me personally, I call it impulse correction continuation. You can call it impulse. You can call it impulse correction impulse, like some people call it that. You can call it break retest continuation. Like, you can call it whatever you want, but the concept remains the same. Impulse correction continuation. And the three phases, they happen on every single time frame. No matter the time frame, it does not, like, it literally doesn't matter. I can go on the monthly time frame and identify impulse correction continuation. I can go to the weekly time frame. I go to the daily, the 4 hour, the 1 hour, the 30 minute. I can even go down to the 1 minute. This concept all applies on every single time frame, right? So let's just go to the monthly time frame just to, check my speed, right? So we can see here, this was gold. Guess what happened? We was breaking structures. We broke this previous high with what? A brand new impulse. This was an aggressive push inside of the market. But then guess what? The market got tired, right? It had to take a little break. So it had to pull back, aka retest, aka correct. So we had this overall correction here. So you can see the difference between corrective nature and a impulse nature. Impulse is aggressive. Corrective is kind of like choppy, a lot slower before you get another continuation, which is another aggressive push. So ultimately, continuation and impulse are pretty much the same thing. That's why I said you can call it impulse correction impulse, or you can call it impulse correction continuation. Whatever the case may be, it's the exact same shit, right? Now, from here, we can see this was our impulse. We had our corrective nature. And then guess what, ladies and gents? We had another continuation, another aggressive push. But then guess what? The market got tired again. So what did it do? It corrected, pulled back, and we had another continuation. Impulse, correction, continuation, correction, continuation. That's the three phases inside of the market. And now, just to check my drift, like I said, this is on a monthly time frame. Let's go down to the 1 minute time frame just so y'all can see it's the exact same thing, right? So on this 1 minute time frame, we can see price was in a overall downtrend. The monthly is in an uptrend, but the 1 minute is in a downtrend. But it does not matter what time frame that you're on, because the concepts remain the exact same. We have a brand new impulse, followed by this correction, followed by another continuation, followed by another correction, another continuation, another correction, and then another continuation. It's that simple, ladies and gents. Impulse, correction, continuation. Even in this little uptrend right here. And this is like for my scalpers that I talked about yesterday. If you want to scout the market, you can take this concept, apply it to your trading right now, and scout the hell out of the market, right? If you're an intraday trader, you can do the exact same thing on the medium time frames, like 30-minute, 1 hour, so forth. If you're a swing trader, you literally, like, even if we take a look at gold on the higher time frame daily. I don't swing trade, but if you did swing trade, guess what? This was a overall impulse, correction, continuation, correction, continuation. Like, it was prominent that gold was going to go up because why? It is following the three phases of the market. Like, it has not broken structure yet. It is telling us it wants to continue going up until ultimately it breaks structure, right? So let's go back to the 1 minute time frame. We can see here on our previous uptrend structure, we had an impulse, we had a correction, we had a continuation, we had a correction, we had a continuation, correction, continuation, correction, continuation. And then what happened? We had an impulse down that broke this structure that let us know, okay, gold was going up for a period of time, ladies and gents, but guess what? It impulsed down. So if it impulsed down, that's the market telling me, hey, shit, let's go down. That's what it boils down to. It's saying that if I have a aggressive impulse down that is breaking this structure, it is telling me, hey, Mike Lito, I want to go down, but you got to wait on this correction first before you say it's guaranteed to go down. And then guess what? Continuation. What is that? What does that mean? Ring, 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 ring. Get money. That's what it means. Impulse correction, get money. Impulse correction, get money. Impulse correction, get money. It's that simple, ladies and gents. So, like I said, this applies to every single time frame, no matter the time frame that you're on. And really, I shouldn't delete that because I need that for y'all to get these definitions. But it's that simple. It's literally that simple, and I cannot break it down any clearer to y'all. That's just how the market moves. Impulse, correction, continuation. Impulse, correction, get money. Make money on the continuations. Is that don't be the idiot that jumps in the market simply because you see it going up. Wait on the freaking pullback. Wait on the retest. Wait on the correction. Whatever the case may be. Just wait. That's all you got to do, ladies and gents. This is, when you think about it like this, right? Let's just say my dog got loose. If I go chasing after the dog, running down the street after a fast ass dog, and my dog, he's pretty fast. If I go chasing him down the street, guess what? I'm probably not going to catch him. Am I faster than him? Yeah, I probably am, because I'm really fast. But he got all the zigzag moves. He can turn, he can do all of that, right? So that means it's going to be very hard for me to catch him if he's running it away from me. If he's impulsing away from me, it's going to be hard for me to catch him. But guess what? If I go get that squeaky toy, his favorite toy, the little tennis ball, and it squeak, or if I got a treat in my hand, I say, hey, I got a treat. Guess what? He going to stop that impulse, and he going to slow down, and he going to come right back to me. He going to come right back to me, and boom, I can grab him by his collar and say, get your butt back in the house. No, I'm just playing. But I can grab him by the collar and I say, okay, cool. Like, I have him now. So I let him come to me. I let my dog come to me versus me chasing my dog. So the same thing in the market. It's like, let the market come to you. So if you see the market, if you see structure forming like this, and then you see a brand new impulse in the upwards direction, and Mike Lito said in Trading Camp Day 2 that I should not try to buy the breakout. All I got to do is wait for price to correct itself and pull back, and then I can catch the continuation. That means that I can make money. Is that, oh shit, damn, y'all couldn't even see it. Hold on. Now I got to do it over because I have my face in the screen. But what I was saying was, if the market impulse is break structure here, and then it gives me an overall correction, you don't want to, like I said, you don't want to be the idiot that buys right here, because guess what? It's going to pull back at some point. So it's going to correct. More than likely, it's going to pull back to here. And then all you got to do is let the market come to you, and then you can get money. Now, of course, this is the complex portion of it, because there is still a lot more details that we have to go over throughout the 15 days of trading camp. But this is the main concept. This is the foundation. So if you already understand some, like, at least something of trading, you can apply this concept. You literally can go back and back test and say, like, all right, let me identify the impulses. Let me identify the corrections. Let me identify the continuation. Even on gold, look at this uptrend on gold. This is on a 4-hour time frame, right? So what do we have? We had a impulse push up. That's the market saying, hey, let's buy gold. We pull back, we correct it. We had a continuation. We had a pullback, we had a continuation. We had a correction, we had a continuation. We had a correction, we had a continuation. And you can see every time it's going to pull back. It never goes straight up. And then your job as a trader is to identify this where we get a little nitty gritty chat. Your job as the trader is to identify where is the correction going to pull back to before it gives us our continuation. And guess what? We're going to talk about that leading up to the boot camp. I mean, not the boot camp. I don't call it boot camp. I already did the boot camp last year. We leading up to the trading camp, right? So this leaves us with that question. How will I know when price pulls back in my correction that it is ready to catch the continuation? So with that being said, ladies and gents, you got to stick around for the rest of the remaining days because we're going to talk about it. But I can't give it all to you in one day. We got to do day 1. We got to do day 2 so y'all can process what exactly it is that I'm telling y'all. So y'all can take it, study the video at 5:30. So as soon as this video drops at 5:30, you need to watch it. You need to go to your charts. Today is Friday. It's the weekend. The market's about to close. Go back, test it the whole night, and then show up for day 3 tomorrow. And then we're going to learn more and more details about how the market moves, learning corrections, learning continuations, and how to make this into your own bulletproof strategy that you can use inside of the market. But of course, remember, like we talked about yesterday, none of this means anything if you can't master this. So I remember I heard a boxing coach one day. He said, protect the dome, protect that dome. And that's exactly what I need y'all to do. So even though we learned about, the market and the technicals, still need y'all to protect that dome. A lot of y'all was asking about comments inside of the comment section on day 1. Y'all asked about books. I left the whole book list inside of the comments. So I think I'll go ahead and pin it so y'all can see it. But I did answer a lot of y'all questions as well. So if you have questions about this, just like I told y'all yesterday, drop your questions inside of the chat. And I will write back to y'all. I will answer y'all questions. And then I'll even probably spend a day where I take a sum total of the questions that y'all put that I can't really type out. I'll probably just answer them on here, like a Q&A day, so forth and so on. That way, y'all can hear me actually vocalize the answers to y'all questions versus me just typing them out, right? But like I said, make sure that y'all put those questions inside of the chat. And this concludes day 2 of trading camp. Make sure y'all show up tomorrow because we're gonna go a lot more in depth into the market and actually market structure. And let's get it. It's time to get this money. See y'all tomorrow.